What's up guys, welcome back to the Daily Stock Picks, and in this video we'll be going over 4 perfect stocks that every beginner should consider buying according to this article by Investors Place. So what I'll be doing here for you guys is I'll be reading over this article with my beautiful voice, commenting, and we'll be conducting my own quantitative analysis to see whether these 4 companies either belong in our dividend portfolio or our value portfolio at their current prices. So if you guys feel like being awesome and amazing, make sure that you smash the like button for the YouTube algorithm. I would really appreciate it. Now without further ado, let's get this video started. 4 perfect stocks to buy for beginners. These offer low volatility and healthy cash flows from businesses relatively immune to economic swings. By Faisal Humayun. Hope I'm not pronouncing his name wrong. But yeah, so with another round of funding, Robinhood has seen its valuation surge to $11.2 billion. It's not surprising considering the fact that the company added 3 million new customer accounts at the beginning of the fiscal year 2020. As markets continue to trade near all-time highs, retail investors' interest remains elevated. Capital preservation is one of the most important objectives when selecting stocks to buy for beginners. So that is a good motive because a lot of beginners generally go into riskier plays, but in order to get substantial returns, you do not need to take that much risk, provided that you stick with the fundamentals, right? So the initial losses might scare new investors from markets that have consistently been able to beat most asset classes in the long term. Even if there is a correction, it would provide an opportunity for entry for the long term. Laura Gonzalez, PhD Associate Professor of Finance at California State University in Long Beach, outlined the strategy for beginners. Beginning investors need to keep in mind that the opportunity to enter the financial market is based on institutional and regulatory protections, as well as the need to time the entry, she said. The goal is to buy low, minimize fees, and let long-term diversified investments take care of the market fluctuations. There is no need to invest large amounts. The key is to start small, strategically, and don't wait until middle age. I see the keywords as attractive valuations, long-term exposure, and a diversified portfolio. Let's look at 4 stocks to buy for beginners. These names are worth holding in the core portfolio for the next few years. So these are the 4 companies which we will be going one by one, right? So stocks to buy for beginners: Costco Wholesale, ticker symbol COST. In the list of stocks to buy for beginners, Costco stock is among my top picks. The stock has a beta of 0.69 and is a perfect defensive stock for beginners. In addition, the company currently has a dividend payout of $2.80 per share, and dividends are likely to increase in the coming years. In terms of business, Costco currently has 55.8 million households as members. Wow. Further, the company generated $3.5 billion in cash fees in the last 12 months. With 91% renewal rate in US and Canada, there is a clear cash flow visibility. So 91% is really large in terms of renewal rates. So yeah, another important growth factor is that Costco started building a presence in China. The company has ample financial headroom for aggressive growth. In the coming years, cash fees should continue to trend higher. The company's focus on e-commerce is also delivering results. For the 48 weeks ended August 2nd, the company reported 46.1% growth in e-commerce sales on a year-over-year basis. With all these positives, Costco stock has been an uptrend. I believe that the positive momentum is likely to sustain, and beginners can consider gradual exposure to the stock. So what the writer is saying that you should start buying the stock gradually, but in order to intensify or compound the amount of returns, we want to be buying the stock when it is at a discount or whenever it is at a bargain, right? So in order for Costco to meet my dividend portfolio, it needs to meet 4 rules. And these 4 rules are basically based on these 3 books that I read. The first book is Dividends Still Don't Lie by Kelly Wright. And the second book is Get Rich with Dividends by Mark. And the third book is The Ultimate Dividend Playbook by Josh Peters. So it is a really good read. Make sure that you guys check it out. You can just Google it or go into Amazon. You should be able to get a Kindle version or a PDF version. Next. So the dividend portfolio rules are as follows. Rule number 1 is that the current free cash flows must be positive. So free cash flows are the amount of money that the company is able to get physically after paying out all its capital expenditures, right? And we want to be making sure that we're investing in a company that has a good free cash flows so that you can sleep well at night knowing that your money is working for you, right? And the rule number 2 is that the dividends paid out should not be more than 75% of the current free cash flows. What do I mean by this? So generally companies pay, like wonderful blue chip stocks tend to pay out dividends, and these dividends we need to make sure that at least 25% of the free cash flows is being retained by the company, and so that they can at least grow the business that is mutually beneficial for the company and its investors, right? And rule number 3 is that consistent dividend growth history of at least 5 years. So companies of such that pay a dividend do tend to increase their dividends year over year at some basis percentages. I generally like to look for companies that are minimum of 5 years, but if you want to be on the more conservative side, you can look for companies that have been growing its dividends for the past 10 years as well. And rule number 4 is our buy criteria. So we only want to be buying or entering into the stock when the current yield is greater than or equal to the 5-year dividend yield average, or very, very close to it, right? Just so that we know that the company is at a bargain at the current valuations. Now, so let's see, type in Costco, ticker symbol COST, into the tracker. We can see that the price to earnings multiple is 41.5, which is higher than the S&P 500 index average of 30.16, right? So I like to use Y charts because they do a good visual representation of all the financial information on a graph format rather than looking at boring old numbers. Since I like to look at something visually so that I can grasp the information much easily, right? So looking at the revenues, they have been increasing along with the free cash flows. So the free cash flows, you could say from the past 10 years, it has doubled, around doubled, you can say. So around 10% growth year over year, if you were to look at it on an average. So the free cash flows are definitely a positive because it's $3.358 billion. And Costco dividend is all over the place, but currently it is paying out $1 billion as in terms of its free cash flows as a part of a dividend. So 1.038 divided by 3.358 gives us, it's equating to around 30% of the free cash flows. So the remaining 70% can be invested back into the company, like in the article as we read, expansion in China and stuff like that. So the remaining 70% can be used in that way. So as a result, the dividends are not more than 75% of the free cash flows. Now let's see how consistent Costco has been increasing its dividends over the years. So Costco, even though that the dividends have been zigzag, it has been increasing its dividends over the past 16 years at a rate of 15.28%. So just imagine, guys, you working for like a company and it's increasing your income by a 15%, which is unheard in any job market, right? So that's the benefit of investing in stocks. It's the most passive thing that you can do. And if you do invest in Costco at the correct price, you can rest assured that you would be compounding your growth rate year over year if you decide to invest the dividends back into the company, right? And now we can see it's definitely more than 5 years. And for all the conservative dividend investors out there, it's paying out dividends over the past 16 years. So it's about 10 years as well. Now, Apple's dividend, looking at Costco's dividend yield, just type in Costco and the ticker symbol in the dividend yield history, we can see that the current dividend yield is 0.97, but the 5-year average is 1%. So since it's just off by a little much of 0.03%, you can still consider buying the stock at this current valuation because it's not that of a huge stretch, right? It's 0.03%. So you won't be getting that much dividends. It's around 1% that you would be getting it as. So, but irrespective of the fact, this is a wonderful company that you can invest in, considering the current valuations based on the dividend portfolio theory. So dividend portfolio definitely as a part of this. And just for fun, let's just check out when it was maximum. So we can see that in July of 30th of this year, the dividend yield was around 1.03%, right? Which is higher than the dividend yield, current dividend average. So if you were to look at July stock price, July 30th. So July 30th, the stock was trading somewhere around $324, and now it's trading around $347. So So 0.347 divided by 324. So around a 7% growth rate within a span of 2 to 3 months. That is pretty good, but I still think that the company has a large potential to increase in the coming years because of its unique competitive moat, right? Now, let's see if, just for fun, we know that it meets our dividend criteria just by a little bit. So I would, just for fun, want to check out if it meets our value portfolio criteria as well, right? So in order for a company to meet my value portfolio, it must meet my 5 rules. So the 5 rules are based upon these 3 books that I read: The New Buffettology by Mary Buffett and David Clark. Mary Buffett is the daughter-in-law of Warren Buffett, or used to be the daughter-in-law of Warren Buffett. The second book is Rule Number 1, Investing by Phil Town, and the third book is The Little Book That Still Beats the Market by Joel Greenblatt. I absolutely enjoyed reading this particular book as he goes into the intricacies of companies and what you should be looking for, right? And his magic formula, infamous magic formula, right? And these are the 4 rules, right? So the rule number 1 is that the return on invested capital must be greater than or equal to 10. Generally, as a rule of thumb, you want to be investing in companies that have a return on invested capital of more than 10%. So it's just basically the profitability of the company, right? So the higher the number, the better the company is. And rule number 2 is that it needs to have a consistent net cash flows. So the cash flows that we'll be looking at needs to be so consistent that you should be able to project the cash flows or ballpark the cash flows to a certain extent for the next 10 years. And rule number 3 is it needs to have a strong balance sheet. So generally companies take on long-term debt because they want to increase the rate of growth for the company rather than waiting for that liquid cash to come in terms of revenue, right? So we want to be making sure that the management is managing the long-term debt sufficiently, and it should be able to clear it off within 6 years or less than 6 years. That is a good thumb rule that I follow. And rule number 4 and rule number 5 is the buy criteria. So we want to be buying the company when the current price is lesser than or equal to 80% of the fair price, which we'll be calculating with our Google spreadsheet. And if the rule number 4 doesn't meet, we can look at rule number 5 when the current price to earnings ratio is less than 50% of the highest PE ratio over the past 5 years and lesser than the S&P 500 index. More on that later. It'll make sense as we go and analyze the company. but I just wanted to put these rules out there, and these are just my rules. You can make up your own rules by reading out books and stuff, and whichever resonates more with you, right? So Costco stock, we want to be checking out Costco, C-O-S-T. As you can see, the return on invested capital is definitely about 10%, so the company does have some sort of competitive advantage working in its favor. And even at its lowest point, it's about 10% of 10.25. And the revenues have been increasing consistently along with the free cash flows. You could say that they've doubled over the past 10 years at a rate of 10% year over year, CAGR, compounding annual growth rate, right? And the dividends part we've already analyzed, but now let's look at the balance sheet portion of it. So the long-term debt in its quarterly balance sheet is $9 billion. And the total current assets is basically the assets which can be liquidated into cash within 12 months or less. So these are the most liquid assets that are on the balance sheet, right? And it has around $25 billion. Let's say tomorrow that Costco needed to pay this $9 billion to its long-term debt. It can literally pay it off within a single year or instantaneously if the company chooses to do so, or if the management chooses to do so, right? So that is a strong position, and it is a cash cow. Now, in order for us to calculate the fair price and to see if the conditions are correct for us to invest into Costco in terms of a value perspective, we need to be calculating the intrinsic value of the company. Intrinsic value of the company is nothing but what the company might be worth 10 years from now. Okay, so the earnings per share is $8.36. Now we want to be seeing the price to earnings multiple, or the range at which Costco has been trading over the past 5 years in terms of its price to earnings multiple. We'll just be entering this details over here, 41.67. So the average is 33.55. Now Costco is expected to grow at 7.15% over the next coming 5 years. So what we're doing here right now is we're taking these earnings projections into 10 years by multiplying with the analyst estimates, right? So when we arrive at the earnings per share 10 years from now, the diluted ones, we want to be making sure that we are multiplying this earnings with the proper price to earnings multiple. So this is where our job comes into picture. We can either use the price to earnings ratio of the current 5-year average, or we can multiply the analyst estimates so that we can get a multiplication ratio. So 33.55 and 14.3. So whenever we're selecting a ratio, we want to be making sure that we're selecting the most conservative one so that we can at least be sure that even if it doesn't reach that, our downside is basically protected, right? So the intrinsic value of Costco is going to be somewhere around $222.57 per share. And the fair price at which we should be buying the stock, considering a 15% return on our investment year over year for the next coming 10 years, the fair price is $63.27. So you should always know that the fair price, we should never be paying that. We need to be paying below that. Suitably, ideally 50% of this would be $31.63 if that is the stock price that you should be entering in the stock, so that you're buying literally $1 for 50 cents, right? And you can make an exception and start entering the stock when it's at 20% markdown from its fair price, right? That would be $50.62. As a result, we can see that Costco is currently trading at $347.78 per share, which is a lot expensive, as investors are willing to pay a lot more in order to own this particular stock. As a result, as a pure intrinsic value perspective, it doesn't meet the criteria. And if you were to look at the fifth buying principle, the current price to earnings multiple should be less than 50% of the highest price to earnings ratio. So it is trading at its all-time highs in the past 5 years. So as a result, it doesn't meet our criteria, and it's not even cheaper than the S&P 500 index if you were to look at that in terms of that perspective. So as a result, Costco is a very close buy for us to consider in our dividend portfolio, but not a part of our value portfolio. Just keep in mind the starting dividend yield is very low, but the compounding effect that it has to offer, it is around 15%. So that dividend is going to grow around 15% year over year, at least for the next coming 10 years, right? Now let's have a look at the second company in our list. It is Apple, ticker symbol AAPL. So Apple stock is another name that should be among the top stocks to buy for beginners. The stock has surged by 146% in the last year, but I believe that there is more juice in the rally. Recently, Wedbush analyst Daniel Ives raised the stock target price to $600 with a bull case target of $700. With Apple stock currently trading around $500, there is ample scope for upside. The first reason to like Apple is that the company is a cash flow machine. For the first 9 months of the year, the company generated operating cash flows of $60 billion. The company has also nearly $200 billion in cash and equivalents. This leaves ample scope for shareholders' value creation through dividends and share repurchase. In addition, the company's financial flexibility allows investment in innovation and inorganic growth. Recently, the company acquired a virtual reality firm that creates immersive Zoom calls. Apple is also more diversified with strong growth in services and wearable segments of the business. Overall, with healthy earnings growth, focus on innovation, and continued shareholder value creation, Apple stock is worth holding. Okay. Now let's see if this company meets our dividend portfolio, but more on that. But let's have a look at Apple's price to earnings ratio. We can see that Apple's price to earnings ratio is 9.93, which is definitely on a discount when compared to the S&P 500 index. Just remember, guys, Apple recently had a stock split of 4-1. So as a result, the price would have come down to nearly $100 or so, which is a really attractive price for retail investors. But we want to be looking and seeing if it is at a markdown so that we can consider buying this particular stock, right? Now, Apple, AAPL, the revenues are going to be pretty phenomenal. Revenues have been increasing consistently. The free cash flows, 16. Let's see how many times it has doubled. So 16, 32, 64. So around 2 doubles. So around the free cash flows were growing around 15 to 20% growth year over year on a compounding annual basis, and it does pay out a dividend. So the free cash flows are definitely a positive. Now let's see how much the dividends are equating to. 14.12 divided by 58.90. So that equates to around 23% of its free cash flows. So the remaining percent can be reinvested back into the business, which is a healthy amount. And let's see how long Apple has been growing its dividends over the past years. So it has been growing its dividends over the past 8 years at a rate of around 10.50%. So definitely a yes, because it meets our minimum criteria. So since it's like a really good company, even for conservative dividend investors who look for 10 years or more, I would recommend buying into the stock or looking into the stock. Okay, and now let's look at the Apple's dividend yield. So looking at the dividend yield, we can see that it is 0.61, which is way lesser than the Apple's 5-year average, which is around 1.54. At the current valuations, Apple doesn't seem to be a good buy because of the valuations that it's projected in terms of a dividend perspective. So we want to be buying the stock when the averages or the dividend yield is higher than the 5-year average. So just for fun, if you were to invest in this company back in May of 2019, when the dividend yield was around 1.66, May 28th, right? Let's have a look. May 28th, 2019. Yeah, the stock was trading somewhere around $44 per share. That is on after the split basis, and you would have gained nearly $44, nearly 44 times, okay, 45, you can say 90 to I'm just trying to calculate how much it's doubling. So you can expect that you would have nearly more than doubled your investment in the span of a single year or more. So more than 100% return on your investment in Apple, right? Now, let's have a look at the value proposition of this company, right? To see whether Apple, it doesn't belong in our dividend portfolio with its current valuations, but we can definitely see if it meets our value criteria. So the return on invested capital is just plain bananas. So even at its lowest point, the return on invested capital is more than 20%. So as a result, return on invested capital is about 10%, definitely meets the criteria. The revenue that we can see here and the free cash flows we've already analyzed, it's pretty consistent. You should be able to predict the future cash flows to a certain extent. Now let's look at the balance sheet. We already heard that the balance sheet is pretty phenomenal, but I want to see it in numbers. So the total long-term debt is $112 billion, which is really large, but the current assets that it has on its balance sheet is $140 billion, and it can clear it off instantaneously in the coming 12 months if the management does decide to do so. Now let's calculate the fair price. So the earnings per share is 3.288, and now let's look at the price to earnings multiple of Apple in the span of 5 years. 9.917, 39.70. So Apple is expected to grow at 12.46%. Okay, looking at the price to the earnings multiple, it is at an all-time discount when compared. So the multiplication ratio, to be on the conservative side, we will be using 24.81. The intrinsic value of the company that we should be worth 10 years from now is going to be $234.70 at this projected growth rate, and the fair price at which we should be buying the stock is 66.72, and the price at which you should be considering entering into the stock should be around $53.37. So as a result, you can consider the stock to buy it if it was around this range, but unfortunately it doesn't meet our rule 4 criteria. But let's look at rule number 5. I think it has been met. So the current price to earnings ratio is 50% of the highest price to earnings ratio, definitely. And it is lesser than the S&P 500 index, which is also true in this case. So as a result, you can consider buying Apple as a part of the dividend of value portfolio just by looking at its plain earnings, right? I wouldn't be buying too much of it, but you can do a little bit of research to see if the management and read a little bit of financial statements to see if it does meet the criteria. But Apple stock, if you want to invest in it, I would recommend it at this current valuation because of its price to earnings multiples, right? And now let's have a look at the next stock in this list. Is Lockheed Martin, ticker symbol LMT. LMT stock is another name that has a beta of less than 1. In addition, the company offers a dividend of about $9.60. With the defense sector immune to cyclical swings in the economy, Lockheed Martin is a core portfolio stock. As of second quarter of 2020, Lockheed Martin reported an order backlog of $150 billion. So recently, the company won a $62 billion contract for F-16 foreign military sales. As the order backlog swells, the company has clear revenue and cash flow visibility. The recent foreign military sales contract is also significant as the company's sales diversify beyond the United States. I also like the fact that LMT stock is currently trading at a price to earnings ratio of 16.4, with the S&P 500 index trading at a PE ratio of 29.8. The stock is relatively attractive. Further, the stock has been extended consolidation zone with returns of 4.8% in the last 1 year. I would not be surprised if there is a breakout on the upside. Okay, now let's have a look at Lockheed Martin, LMT. If you were to look at the price to earnings ratio, you can see it is at around 50% discount when compared to the S&P 500 index, just based on the price to earnings multiple, right? Now, ticker symbol LMT. So the revenues have been increasing. Free cash flow is $2 billion. You can say that it's almost a double, so around 10% compounding annual growth rate over the span of 10 years. Okay, so free cash flow is definitely, and it is paying out a dividend. Let's see how much the dividend equates to. So 2.556 divided by 5.827, that equates to around 43%, and the remaining 57 odd percent can be reinvested back into the business. So I would say it still does meet our criteria. Now let's see how consistently Lockheed Martin has been growing its dividends. So looking at the consistency, we can see that Lockheed Martin has been paying dividends since 1996, but it has only been growing its dividends over the past 1 year. As a result, this does not meet our particular criteria, right? So we want to be looking at companies that paying out dividends is the main criteria, and they have a tendency to increase the dividends, right? Maybe because the fluctuations in the cash flows and stuff like that, the management isn't deciding to increase the dividends year over year. Due to that, I wouldn't be looking into the stock, but if you were to look at the current valuations of Lockheed Martin, it's 2.42, which is pretty less when compared to the average 5-year dividend yield as well. In terms of a dividend perspective, it wouldn't meet our criteria. But now, going to a value proposition, let's see. Lockheed Martin. Return on invested capital, pretty phenomenal, 39.71%. And even at its lowest, it was somewhere around 13.37%. Free cash flows are pretty strong. And the balance sheet. So in the balance sheet, we can see that it has around $12.67 billion in long-term debt, which it can easily clear off with its current asset levels of $19 or $20 billion. Now, let's calculate the intrinsic value of the company, 22.82, and the price range at which the price to earning multiple has been trading over the past 5 years, 12.62, 51.28, and the analysts are expecting for this company to grow at 9.11%. So 9.11% multiplication ratio. So the minimum one that we should be considering is 18.22. The intrinsic value is going to be somewhere around $911. The fair price $259. The price at which we should be entering the stock is going to be around $207 per share, which is not yet currently at the moment, which is nearly $200, nearly double the amount, right? So as a result, it doesn't meet our fourth principle of the bright criteria. But coming to the fifth principle, we can definitely see it is cheaper than the S&P 500 index, and the current price to earnings multiple is lesser than the 50% of the highest price to earnings ratio. So as a result, if you were to buy it in terms of a value perspective, you can buy it due to rule number 5, like similar to Apple in terms of the price to earnings multiple, right? Now, coming to the last stock is AstraZeneca PLC, ticker symbol AZN. So AZN stock is another name that has a significantly low beta of 0.26 and is worth considering for beginners. The stock also pays an annual dividend of 1.4%. I also like AZN stock as the company gives new investors exposure to the pharmaceutical sector, which has been in the limelight since the novel CVPD. Besides being a frontrunner in the race for the CVPD vaccine, there are other reasons to like AstraZeneca from a business perspective. The company has a strong late-stage pipeline of drugs, and that will translate into strong growth in the coming years. It's worth noting that the new medicine segment delivered 45% growth in the first half of 2020, with the oncology division delivering 31% growth. If the development remains positive related to the CVPD vaccine, earnings growth can accelerate in the coming year. Overall, AZN stock is worth holding in the portfolio and offers protection against market volatility besides growth visibility. I also expect the company's dividend to increase in the coming years. All right, now let's have a look at the price to earnings multiple of AZN stock. 68.76, definitely not at a discount. It's nearly twice as expensive when compared to the S&P 500 index. But now let's see if it does meet our dividend portfolio rules, right? AZN. The revenues have been falling, which is not a positive sign, along with the free cash flows. So it was around $8 billion. Now it has $500 million. And the amount of dividends that's being paid out is more than the current cash flows that it's able to bring in. Even though that might have a really good growth prospects, I wouldn't even be touching this company because of this, and it doesn't even meet our dividend portfolio or our value portfolio because of its current free cash flow levels, right? So closing remarks. So Faisal Humayun is a senior research analyst with 12 years of industry experience in the field of credit research, equity research, and financial modeling. Faisal has authored over 1,500 stock-specific articles with focus on technology, energy, and commodity sector. As of this writing, Faisal Humayun did not hold a position in any of the aforementioned securities. So if you're watching this part of the video, thank you so much for sticking around. I really do appreciate it. And if you guys do feel like being awesome, make sure that you smash the subscribe button and turn on the bell notification icon so that you can get these videos notified as soon as I post them. So full disclosure guys, this video is for your education and entertainment purposes only. There is no guarantee that you'll earn any money using these techniques and the ideas mentioned in this video. This is not a financial advice. Please consult your financial or tax professional prior to making an investment in these companies. So thank you so much. Really appreciate it, and catch you in the next video guys. Peace.